If you are a Gulf NRI and you want your money working in global markets, not just India, you have probably heard of ETFs. Maybe you have already bought one. But here is a question most people never think to ask. Where is your ETF registered? Because if the answer is the United States, and you are a non US person holding assets above a certain level, you could be walking into a 40% inheritance tax problem, and you would not know it until it was too late. I made that mistake too. I used to invest in US based ETFs, the popular ones, the ones everyone talks about. Before I understood the domicile problem, I switched. And in this video, I am going to make sure you have everything you need to get this right from the start. We will cover what an ETF actually is, how it works, how it compares to stocks and mutual funds, and most importantly, why where your ETF is registered is not a small detail. For NRIs like us, it is one of the most important decisions you will make. Let us start from the beginning. Remember, an ETF is one of the most powerful tools in modern investing, but only if you use it correctly. Domicile is not small print. For NRIs, it is a real financial decision. What is an ETF? ETF stands for Exchange Traded Fund. Let me break each word down. Exchange. An ETF is listed and traded on a stock exchange, just like a company share. If you have ever bought a share of any company, the mechanics are exactly the same. You go to your broker, search for the ETF ticker, and buy it at the market current price. Traded. Unlike a traditional mutual fund where you buy at end of day price, an ETF trades through the day. Its price moves in real time as the market is open. That flexibility is part of what makes ETF useful for investors who want control over their entry point. Fund. Here is the important part. An ETF is a fund, a basket of assets. When you buy one unit of an ETF, you are not buying one company. You are buying a slice of dozens, hundreds, or even thousands of companies in a single trade. For example, one unit of an ETF tracking the S&P 500 give you instant exposure to 500 of the largest companies in the United States. Apple, Microsoft, Amazon, Google, all in one purchase. Remember, one ETF unit, hundreds of companies, one trade. That is what diversification looks like in practice. How does ETF work? Most ETFs track an index. The ETF provider, companies like iShares, Vanguard, or Xtrackers, buys the underlying assets in the same proportion as the index. As the index rises or falls, so does the ETF's value. There are two ways an ETF can do this: physical replication, where the ETFs actually buys and holds the stock in the index, and synthetic replication, where it uses financial contracts to replicate the returns without buying the actual stocks. For most long term investors, physically replicated ETFs are the simpler and clearer choice. Accumulating or distributing. When you look at ETF listings, you will often see two versions of the same fund, one labeled ACC and one labeled DIST. Accumulating or ACC means dividends paid by the underlying stocks are automatically put back into the fund. Your unit grows in value over time. This is more tax efficient for long term wealth building. Distributing or DIST means dividends are paid out to you as cash. Useful if you want regular income. For NRIs building long term wealth from the UAE, ACC is almost always the better choice. ACC or DIST. If you are building wealth, choose ACC. Let compounding do the work. Before we go further, let me quickly cover two related products you will come across: ETNs and ETCs. I am not spending too long here because these are not the main focus for most NRI investors building a long term portfolio, but you should know what they are. An ETN is a debt instrument, basically a note issued by a bank. Like an ETF, it tracks an index or asset, But unlike an ETF, you do not own the underlying assets. You own a promise from the bank to pay you the return of the index. The risk here is simple. If the bank that issued the note goes under, you could lose your investment, even if the index itself performed well. Think of it like a loan to the bank. If the bank fails, the loan goes with it. ETNs are not suitable for most long term retail investors. If you see one, treat it carefully and understand exactly what is behind it. And etc give you exposure to a single commodity like gold, silver, oil. It works similarly to an ETF but is built around one commodity rather than a basket of stocks. The most common example is a gold ETC. Some are physically backed, meaning they actually hold gold in a vault, which is the safer version. Remember, ETFs are the engine, ETNs are a promise, ETCs are a commodity bet. For your core portfolio, stick with ETFs. Now, a question I get asked a lot: why not just buy individual stocks? If a company like Amazon has made people a lot of money, why spread across 500 companies? I want to be fair here. Stocks are not bad. If you have the time, the knowledge, and the focus to study individual companies, you can absolutely build a good portfolio of stocks. The world's best investors have done exactly that. But for most of us, NRIs managing a job, a family, and investments across 2 or 3 countries, the reality is different. Here is why I personally lean on ETFs. 1. Instant diversification. One ETF gives you hundreds of companies. A single stock is one bet on one company. 2. No single company risk. If one stock in the index collapses, and we have seen this happen to major companies, your ETF barely moves. A concentrated stock position can wipe out a large portion of your savings overnight. 3. Lower research load. You do not need to track quarterly results of 20 different companies. The index does the heavy lifting. 4. Discipline by design. An index ETF forces you to own the winners. As a company grows, it enters the index. You get the benefit automatically. 5. Low cost. Most ETFs charges between 0.05% and 0.2% per year. That is significantly less than active fund managers. I am not saying stocks are wrong. I am saying that for an NRI building global wealth without the time to deeply research individual companies, ETFs gives you the exposure with less single company risk. If you want a small portion in stocks you believe in, that is perfectly reasonable add on. But the core, ETFs. Remember, stocks, you are betting on one horse. ETFs, you own the whole race. One bad horse doesn't stop the race. ETFs come in several types. Let me walk through the main ones you will come across as a UAE NRI. For most NRI investors building long term global wealth, equity ETFs are the core holding. Multi asset ETFs are a good starting point if you want one fund to do most of the work. Gold ETCs are a useful hedge, but make sure they are physically backed. Thematic ETFs are fine as a small satellite position, not your main allocation. S&P 500, 500 largest US companies, the standard benchmark for US equity performance. MSCI World, around 1500 companies across 23 developed markets. Global diversification in one index. MSCI Emerging Markets, around 1400 companies across 24 emerging markets, including India, China, and Brazil. Nifty 50, 50 largest listed companies in India, the main Indian equity benchmark. Nasdaq 100, 100 of the largest non financial companies on Nasdaq. Tech heavy, higher swings. Remember, you do not need to know every ETF. You need to know which index to own and then find the best Ireland domicile ETF that tracks it. This section is the one I wish someone had explained to me clearly when I started investing globally. It is not complicated once you see it, but it is a decision that can have real financial consequences for NRI investors. When you buy an ETF, the fund is registered in a specific country. That country is called the domicile. The two most common domiciles for ETFs that Gulf NRIs can access are United States and Ireland. On the surface, a US-based S&P 500 ETF and an Ireland-based S&P 500 ETF tracks the same index, same companies, same performance, but for a non-US investors, they are not the same product. The United States charges an estate tax on assets held in the US-based funds by a non-US persons when they pass away. The exemption limit for non-US person is only $60,000. That sounds like a lot until you realize that even a modest global ETF portfolio can cross this level quickly. Above the 60,000 US dollars level, the US estate tax rate is 40%. This is not a theoretical risk, it is a legal obligation. If you hold US based ETFs and you pass away, your family may have to pay 40 cents on every dollar above that limit to the US government before they receive anything. The UAE has no estate tax agreement with the United States. You get no reduction or exemption, and the India US tax treaty covers income tax only. It does not cover estate tax. When US companies pay dividends into a US based ETF, there is a 30% tax taken out before it reaches you as a non US investor. The US government takes 30 cents of every dividend dollar before it compounds in your fund. Ireland based ETFs benefit from the US Ireland tax agreement, which reduces this to just 15%, half the drag on your dividend income. For accumulating ETFs which reinvest dividends automatically, this 15% versus 30% difference builds up into a meaningful gap over time. Ireland has become the home of choice for ETFs sold to international investors, and for good reason. How do you identify an Ireland domicile ETF? Simple. Check the ISIN, the fund's identification code. If it starts with the letters IE, the fund is Ireland domiciled. If it starts with US, it is a US based fund. That two-letter check is all you need. Let me be personal for a moment. I used to invest in US based ETFs, the ones with the biggest names and the most discussion on social media, VOO, QQQ, widely covered. When I looked properly at the state tax implications for non US persons, I made the decision to shift my global ETF portfolio to Ireland based equivalents. Same index exposure, same performance, different home for an NRI in the Gulf, that difference is real. Remember, same index, different domicile, very different outcome for your family. Two letters, IE, tell you everything you need to know. If the ISN starts with IE, you are in the right place. You now know what ETFs are, how they work, and why domicile matters. The next question is, where do you actually buy them as a UAE resident? Each platform deserves its own proper walkthrough. Fees, account opening, ETF selection, what works for NRIs. I will be doing dedicated reviews, but let me give you the landscape now. IBKR, Interactive Brokers, one of the most powerful and low cost global brokerage platform available. Extensive access to Ireland domiciled ETFs, popular with experienced investors. The interface takes some time getting used to, but on cost and range, it is hard to beat. Dedicated review coming. Saxo Bank, UAE regulated, strong ETF selection, more straightforward to use than IBKR. Minimum deposit requirements are higher, trusted by many Gulf NRI investors. IG, well established platform, UAE regulated, access to global ETFs, also offers CFDs. For long term ETF investing, use the regular brokerage side only, not the CFD products. WIO. And this is one of I'm most excited about right now. WIO is the UAE digital bank, and this week they launched something significant. Ireland-domiciled ETFs, the exact type of ETFs we have been talking about in this entire video. Remember, the best platform is the one you will actually use consistently. Don't let platform paralysis stop you from starting. Pick one, learn it, invest. You now know what an ETF is, how it works, why it is different from a mutual fund and from individual stocks, what ETNs and ETCs are, and most importantly, why the domicile of your ETF is one of the most important decisions you will make as an NRI investor. Two letters, IE. That is what you look for. That is what changes the outcome. If you like this video, please subscribe now and hit the bell and drop a comment. Are you currently investing in ETFs, US based or Ireland based? Tell me where you are in the journey. I read every comment. I am Siddiq and this is Investing with Siddiq. Investing does not have to be complicated, but it does have to be informed. See you in the next one.